Welcome to this deep dive into the world of trading. If you've ever placed a trade, watched the market immediately turn against you, and felt like the universe was specifically out to get you, well, trust me, you are not alone. Almost everyone goes through that. Today, we're breaking down exactly why this happens and, more importantly, how you can fix it. We're going to explore the biological, psychological, and strategic errors that constantly trip traders up. All right, let's jump right into this explainer and get to work.
Here is our roadmap for today. We'll be looking at the reality of the markets, why your brain is wired to fail, and those fatal strategic mistakes. Then, we'll dive into the math of survival, execution and environment, and wrap it all up with a clear path forward.
Okay, Section 1. The reality of the markets. Uncovering the true odds.
Let's just start by validating some of that pain you might be feeling. When a trade goes south, it feels incredibly personal, right? But the reality is, it's just statistics. Documented regulatory data from brokers shows that between 74% and 79% of retail accounts lose money. That is a massive chunk of people. So if you've been struggling, just take a breath. You're fighting an uphill battle against the majority. But we have to ask, why is that failure rate so insanely high?
That brings us to Section 2. Why your brain is wired to fail, biology versus trading.
Here's the most surprising truth about trading. Our brains literally were not built for this. They were built for basic survival, running from predators, finding food, staying alive. And believe it or not, that ancient hardware is still running the show. When a trade moves against you, especially when there's real money and leverage on the line, your brain processes that financial loss the exact same way it handles a physical threat. It triggers a fight, flight, or freeze response. That's exactly why you might completely freeze up or panic sell at the absolute worst possible moment.
And that biological reaction ties directly into a massive cognitive bias called loss aversion. Behavioral economics shows us that the psychological pain we feel from losing money is actually about twice as powerful as the pleasure we get from gaining that exact same amount. Because of this, it's super common for traders to quickly cut their winners short just to lock in a quote-unquote safe profit, while simultaneously letting their losers run. Why? Because they're desperately hoping it bounces back to break even, just so they don't have to realize that painful loss.
On top of that, there's the incredibly dangerous trap of ego trading. This is what happens when you start trading based on your own feelings and personal theories instead of, actually looking at what the market is doing. It's the classic, well, the market's dropped so much it literally has to go up now approach, completely ignoring a massive downtrend. At that point, you're just trying to be right to stroke your own ego rather than focusing on being profitable.
All right, Section 3. Fatal strategic mistakes, navigating the traps.
Listen, even if you have a totally zen mindset, poor tactics will drain your account just as fast as bad psychology. The first fatal mistake, trading against the main trend. So many beginners try to play the hero. They want to pick the absolute top of a massive rally or catch the absolute bottom of a crash. Statistically, that's just highly unlikely to work out. If you're in a strong uptrend, you shouldn't be trying to catch tiny countertrend moves. Just flow with the market. Focus on buying the dips.
Another huge red flag is flying completely blind without a proper trading plan. You'd be amazed how many retail traders jump into the market for completely arbitrary reasons. Entering a position because it looks high, or buying in just because they saw 3 random green candles in a row. Let's be real here. If you don't have concrete, documented rules for why you're getting into a trade, you are not trading. You're gambling.
And without a solid plan, you are completely exposed to 2 massive emotional hurdles, FOMO and FOLM. FOMO, or the fear of missing out, is that burning, frantic urge to chase a market that has already taken off. You jump in at the top, no logical stop loss, just because you can't stand missing the party. Then you've got the flip side, FOLM, the fear of losing money. This is what makes you hesitate or just completely cancel a perfectly good setup because you're terrified your stop loss might get hit. Both of these will absolutely ruin your execution.
Which brings us to Section 4, the math of survival, risk management.
Now, I know risk management seems like the boring part of trading, but it is unequivocally the key to your survival. The math doesn't lie. A massive mistake folks make is trading way too big. Look at this. If you risk 10% of your account per trade, it only takes a string of 5 or 6 losses to chop your entire account in half. That's devastating. But professionals, they strictly recommend risking just 1% to 2% per trade. That gives you an incredible runway. You could endure 50 consecutive losses before blowing your account. Knowing that immediately takes the psychological pressure off every single trade you make.
But even if you're only risking 1%, you still have to avoid some deadly execution traps.
First off, maxing out your account leverage virtually guarantees that a normal market fluctuation is going to wash you out. Another sneaky one is setting your stop losses way too tight. If you place your stop right inside the normal daily noise of the market, you're basically begging to get stopped out before your trade even has a chance to breathe. And speaking of stop outs, we have to talk about the spread. This is simply the gap between the bid and the ask price, but it catches so many people off guard. Traders will set a beautiful, technically perfect stop loss and then wake up furious because they got stopped out, even though the chart shows the price never actually touched their line. Why? Because they forgot to account for the spread. Always calculate the spread into your stop loss so your winning trades actually have the room they need to play out.
Section 5. Execution and Environment. When and where to trade. A lot of people treat trading like a side gig, just logging on whenever it's convenient, maybe late at night after work, but timing is actually everything. You want to strictly focus on high-volume windows. We're talking the first 2 to 3 hours of major sessions like London or New York. Hour 1 is the open. Hour 2 gives you peak volume and liquidity. By hour 3, those big institutional moves are settling down. If you're trying to force trades in hour 4 and beyond, you're usually just fighting stagnant, low-probability price action.
If you take absolutely nothing else away from this explainer, please memorize this golden rule of focus. One setup, one instrument, one session. You've got to stop strategy hopping. If you're constantly chasing the newest indicator you saw in a random forum, you'll never develop actual mastery. Long-term profitability comes from becoming an absolute master of a single, specific setup on one instrument like gold or the S&P during one specific time session.
And you also need to fiercely guard your environment. Beware the platform trap. Modern trading platforms are deliberately designed using gamification. Think about it. Confetti animations when you execute a trade, flashing top mover notifications. These are specifically engineered to trigger dopamine loops in your brain, exactly like a slot machine. They just want to keep you overtrading so you keep generating fees. Keep your environment clinical and focused.
Finally, Section 6, the path forward, rebuilding your edge. So, what happens if you're watching this and you're currently sitting in a deep drawdown, or you just blew an account? Here is a highly practical, step-by-step roadmap to get back on track. Step 1. Just stop. Walk away and take a mental break. You need to get your brain back to a calm, logical baseline. Step 2. When you do come back, trade with tiny fractional amounts. Your goal isn't to make all your money back by tomorrow. Your only goal right now is to rebuild your confidence and prove to yourself that you can follow a process. Step 3. Invest in your education. Get your hands on some proper backtesting software. Leverage the right tools to build and document a strategy that actually works.
I want to leave you with one final, absolutely crucial thought. Trading is a long game. It's built on flawless execution, not daily ego victories. You have to shift your focus from trying to be right on every single trade to trusting a process over hundreds of trades. Once you let go of that desperate need to be perfect today and you start embracing the math and the discipline of the long term, that is when you truly begin to master the trade. So ask yourself right now, are you trading to feed your ego? Or are you actually trading a proven system? Think about it. Thanks for hanging out with me for this explainer, and I'll catch you on the next one.